You did something most people in this country never do. You saved $10,000. That took discipline. That took saying no to things. That took months, maybe years, of watching that number climb. And the reward for doing all of that? Your bank is paying you $39 a year. Meanwhile, they are lending your money out to other people at 7%, 8%, 22% on credit cards, and keeping most of the difference. You worked hard to save that money. The bank is working your money hard for itself, and the worst part is they are counting on you not knowing the gap. I'm Cave, and today we're going to do something banks genuinely don't want you to do. We're going to run the exact math on what your $10,000 in savings is actually worth to your bank versus what it's worth to you. And then we're going to flip the entire equation, because the moment you understand how this system works, you stop being the product and start being the one getting paid. If this is the kind of breakdown that makes you want to pay attention to your money differently. Hit subscribe before we go further. New video every week. No fluff, no noise, just the math they built the whole industry hoping you wouldn't run. Let's start with the number that should genuinely make you angry. The national average interest rate on a traditional savings account right now is 0.39%. That is the number the FDIC publishes. That is what the big banks, Chase, Wells Fargo, Bank of America, are paying you to keep your money with them. On $10,000 sitting in one of those accounts, that's $39 a year. Not $39 a month. $39 for the entire year. That's the price they've decided your discipline is worth. That's the return on months or years of saying no to things so that number could grow. $39. Now hold that number in your head because we're about to put it next to some other numbers that are going to make it look even smaller. The same banks paying you 0.39% are lending money out every single day. And the rates they charge on the other side of that transaction are not 0.39%. A 30-year fixed mortgage right now is running around 6.8%. A personal loan from a major bank, 11% to 13%. An auto loan for someone with average credit, 7% to 9%. And the one that should genuinely stop you cold, the average credit card APR in the United States right now is 22.8%. That is not the penalty rate. That is not the bad credit rate. That is the average. That is what they charge the normal customer on the normal card after the promotional period ends. So let's run the actual numbers because this is the part banks are counting on you never doing. Your $10,000 earns $39 a year at 0.39%. That same $10,000 lent out at the average credit card rate of 22.8% generates $2,280 a year. The difference between what they pay you and what they collect from someone else using your money is $2,241 per year on your $10,000. You provided the capital. Your deposit is FDIC insured, so you carry none of the risk, and your share of that transaction is $39. That is the business model, and it works because most people never run this math. Let's put a face on it. His name is Marcus. He's 38. He works in logistics, makes $67,000 a year, and he is genuinely careful with his money. He tracks his spending. He doesn't carry credit card debt. He has $10,000 in a savings account at a major national bank, and he is proud of that number. As he should be. It represents real sacrifice. And it has been sitting there for 4 years, earning him the national average. In 4 years, Marcus's $10,000 has generated $156 in interest. That is what the bank paid him. In the same 4 years, that bank has been cycling portions of his deposit out as loans continuously, mortgages, car loans, credit cards, personal loans, collecting somewhere between 7% and 22% on every dollar. Conservative estimate, assuming they lent 80% of his deposit at an average blended rate of just 9%. The bank has collected roughly $2,880 from Marcus's money over those 4 years. They paid him $156. They kept the rest. Marcus does not know this is happening. The bank does not advertise it. The system runs quietly in the background, and it runs perfectly, as long as Marcus never opens a spreadsheet. Now here's the part most people skip because it sounds technical and it isn't. Understanding why the bank can do this changes how you think about everything that comes next. It's called fractional reserve banking. When you deposit $10,000, the bank is not required to keep all of it on hand. They keep a fraction, a reserve, and they are free to lend out the rest. In practice, for every dollar you deposit, the bank can put somewhere between 80 and 90 cents to work immediately. Your money does not sit in a vault with your name on it. The moment it clears, it becomes inventory, raw material. the input to a lending operation that generates billions of dollars a year for the shareholders of an institution that is paying you $39. And here's the detail that makes it complete. Your deposit is guaranteed. FDIC insurance covers you up to $250,000, which means the bank has found a way to borrow your money at 0.39%, take on essentially zero risk on the funding side, and collect 7% to 22% on the other end. The risk is almost entirely on the borrower. The reward is almost entirely with the bank, and the person who made the whole thing possible, the depositor, gets $39. This is not illegal. This is not a scandal. This is just how the system was built. And it was built this way because for most of banking history, the depositor had no alternative. If you wanted your money to be safe, you put it in a bank. If you put it in a bank, you accepted whatever they offered. There was no competition for your deposit. There was no version of this where you could park your savings somewhere equally safe and actually get paid something real for it. That changed. And the banks were very quiet about it changing. High-yield savings accounts have existed for years, but they became genuinely significant during the rate environment that started in 2022 and has largely held since. Right now, in 2026, online banks and credit unions are offering high-yield savings accounts paying between 4.0% and 4.5% APY. Same FDIC insurance, same liquidity. Your money is accessible within 1 to 3 business days. No minimum balance requirements at most of them, no fees. The only thing different is the number. Let's run that math directly against what Marcus has been doing. $10,000 at 0.39% for 4 years, $156 in interest. $10,000 at 4.2% for 4 years, $1,816 in interest. The difference is $1,660. Not from investing in anything, not from taking any risk, not from learning anything complicated, just from moving the money from one savings account to a different savings account. One phone call, 15 minutes, $1,660. That is what the bank collected on the gap between what it paid Marcus and what it could have paid him. That money didn't disappear. It went somewhere. It went to the bank. Now multiply that across every depositor at a major national bank. Chase alone has over $1.9 trillion in deposits. If even a fraction of those depositors are receiving 0.39% instead of 4.2%, the interest income that stays with the bank instead of going to customers is a number with 11 zeros. This is not a small inefficiency. This is a core revenue strategy. The business model depends on most people never making the switch. So let's talk about the switch. Specifically, how it works, what to look for, and what the actual difference looks like compounded over a timeline that matters. The accounts you are looking for are called high-yield savings accounts, sometimes abbreviated HYSA. They are offered by online banks and some credit unions. The names you'll see most often include Marcus by Goldman Sachs, Ally Bank, SoFi, Discover, and several others. Rates change, so I'm not going to tell you exactly which one to open. That's something you verify the week you're ready to move. But the framework for choosing one is simple. Look for FDIC insured. Look for no monthly fees. Look for no minimum balance. Look for a rate above 4%. Everything else is noise. The one thing people get nervous about with online banks is access. They're used to a branch. They're used to walking in and talking to someone, and I understand that. But here's the practical reality. When is the last time you actually needed to walk into a bank? For most people with a savings account, the answer is never. Deposits happen automatically. Transfers happen digitally. The branch is a comfort you are paying for with $1,200 a year in lost interest. That's the actual price of the branch. Now let's talk about what happens when you take that $39 a year and turn it into something that actually compounds. Marcus moves his $10,000 to a high-yield savings account paying 4.2%. That's his emergency fund. It sits there. It does its job. But now instead of earning $39 a year, it's earning $420. That's not retirement money. That's not going to change his life on its own. But it represents something more important than the number. It represents the beginning of understanding that your money can work, and that whether it does or doesn't is entirely within your control. Because here's where this gets serious. The high-yield savings account is not the destination. It is the starting point. It is the place where your emergency fund lives so that it earns something real while it protects you. The real question, the one that actually changes Marcus's financial life, is what happens to the money above the emergency fund. Financial planners generally recommend 3 to 6 months of expenses as an emergency fund. For Marcus, with roughly $3,200 a month in essential expenses, that's somewhere between $9,600 and $19,200. So his $10,000 is almost exactly right for a 3-month cushion. That money stays in the HYSA. It is not for investing. It is not for spending. It is the foundation that makes everything else possible. Because without it, every financial plan you build is one car repair away from collapse. But the moment Marcus has that foundation in place, every additional dollar he saves has a different job. And that's where the math starts doing things that genuinely change the picture. Let's say Marcus redirects $300 a month, a number he can get to just by switching to a high-yield account and cutting 2 subscriptions he audited and didn't actually use, into a Roth IRA invested in a total market index fund, not picking stocks, not timing the market, not doing anything sophisticated, just buying the whole market every month and leaving it alone. $300 a month starting at 38. Historical average market return of 8% annually. By the time Marcus is 65, that account has $319,000 in it. Tax-free. The IRS never touches the gains. He didn't become a trader. He didn't learn technical analysis. He just stopped giving the bank the $1,660 it was quietly collecting every 4 years and pointed that same money at something that works for him instead of against him. And here's the number that should hit hardest. If Marcus had started that same $300 a month at 28 instead of 38, 1 decade earlier, that account at 65 isn't $319,000, it's $703,000. The extra decade didn't contribute $36,000 more in deposits. It contributed $384,000 more in outcome. That is compound interest. That is the math the banks use on their side of the ledger every single day. The question is whether you're finally going to use it on yours. Let's bring this back to the title because I want to be precise about what's actually happening when a bank pays you 0.39%. Banks don't hate people who have $10,000 saved. That framing makes it personal when it isn't. Banks are indifferent to you. What banks have is a business model that generates maximum revenue when you are informed enough to feel secure but not informed enough to move. You have $10,000 in savings. You feel responsible. You feel like you've done the right thing. You are not anxious enough to research alternatives. You are not desperate enough to ask questions. You are exactly where the model wants you, comfortable, stationary, and generating $2,241 a year for an institution that is paying you $39. The moment you run the math, that comfort becomes a choice. And it's a choice you can reverse this week. Here's what the reversal actually looks like, step by step, so this doesn't stay abstract. Step 1, identify what you have in traditional savings accounts right now. Not investments, not a 401k, the savings account, the one earning 0.39% or close to it. Step 2, decide how much of that is your emergency fund, 3 to 6 months of essential expenses. That number stays liquid. It moves to a high-yield savings account. Step 3, open the high-yield account. It takes about 15 minutes online. You'll need your routing and account number from your current bank. Most transfers complete in 1 to 3 business days. You are not doing anything complicated. You are moving money from one FDIC-insured account to another FDIC-insured account and collecting 10 times more interest for the exact same level of safety. Step 4, anything above your emergency fund that is sitting in cash has a decision to make. If you don't have a Roth IRA, that's the next conversation. If you have high-interest debt, that gets addressed before any investing happens. Because paying off a 22% credit card is a guaranteed 22% return, and nothing in the market can promise that. Step 5. Every time you get a raise, every time you free up cash, every time you have money left over at the end of a month, the question you ask is not, what can I afford now? The question is, where does this go so it's working by tomorrow? That is the entire mindset shift. That is what separates the people who build wealth on ordinary incomes from the people who spend their whole career wondering where it went. You saved $10,000. That is real. That required real discipline, and you deserve a real return on it. Not $39. Not the number a trillion-dollar institution decided to offer because it could get away with it. The math exists. The accounts exist. The only thing between you and 10 times your current return on that money is 15 minutes and the decision to stop being comfortable with a number you've never actually looked at. The bank is not going to send you an email explaining this. The teller is not going to bring it up. The system runs quietly and efficiently for exactly as long as you let it. You just ran the math. That part is done. What happens next is up to you.